Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we explore what is possible in the world of investing. If you've just joined us for the first time, a huge welcome to the community. We have a jam-packed episode today. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. We have just come off 2 weeks of Aussie gold. Our best Olympics ever, 18 gold medals for Australia. And so we want to keep the gold party going in our first segment today, because it's not just Aussie gold that's hitting record high. The gold price is hitting a record high as well.
Correct. That's it. We're gonna.
Do you like how I stuck that landing?
Yes, that was really good. Wondering where that was going. But that's not all we're doing in today's episode. We have a new segment called Cheat Sheet, where we're going to look at some of the world's best investors, celebrities, and politicians' portfolios to see what we can learn. And then we're going to close out with another Pimp My Portfolio with Adam Dawes and a community member. So stick around for that.
News and markets.
Gold.
Yes, well, that is the big news that we want to talk about today. We'll cover off what's happening in reporting season in the next episode, but precious metals, gold and silver, they've kind of been bubbling away a bit under the surface, perhaps not getting the attention that they deserve. Yeah. But as we said, like the headline is gold has hit a record high, $25,000 US an ounce. 2,500 US dollars an ounce. Good correction. First time in history it's hit that price.
Yeah, I was surprised. Well, when you said bubbling away, I think that's that's how I feel about it. I've been so caught up in what's been going on in the stock market that I haven't kept my eye on gold. But yeah, up 25% in the last 6 months, up 31% in the past 12 months.
Yeah. Now, to put that in context, Australia's ASX 200 is up 4% in the last 6 months and 12% in the last 12 months. Yeah. America, the S&P 500, up 12% in the last 6 months, up 27% in the last 12 months, still not beating gold.
Yes.
America's NASDAQ up 11% in the past 6 months. It did have that sell-off, as we all remember, up 32% in the past 12 months. So the tech-heavy NASDAQ 100 has just outperformed gold.
The Mag 7 should include gold.
Well, I mean, the question and what we'll talk about is this short term, is it going to sort of revert to a longer term trend and maybe fall a bit, or is this a sign of things to come? So we'll cover off on that. But before we do, the additional context, the additional news, it's not just gold. Silver is also running up 26% in the past 6 months, and extend the timeline, it hasn't done as well, up 25% in the past 12 months. So silver's made its move recently.
Now, we should also put in context not only against the equity market returns, Ren, but its own average returns. Gold has averaged over the past 50 years a return of 6 to 8% in USD. So slightly below equity market returns, but it just really puts into context how ridiculous the price movement has been over the past 12 months.
Yeah. Now, gold is seen as the classic hedge against inflation. Yeah. So it's seen as something that will hold value as your dollars or your currency gets inflated away. But if you look at that 50-year return profile, 6 to 8%, inflation has not averaged 6 to 8%. It's probably averaged half of that, call it 3 to 4%. You can see that gold has outperformed inflation over the last 50 years.
Yeah. I read somewhere else that another analyst, his way of thinking about it is on average, gold is generally 2 to 3% above inflation historically.
Okay.
That's the way that he looked at it.
Now, there are certainly people listening or watching to this saying inflation is undermeasured and the value of our dollar is actually degrading at 6 to 8% or even more a year.
Yeah.
Separate discussion for another day.
That's for the Equity Mates Goes Deep YouTube channel. Okay. That we haven't started. Anyway, Ren, the point of this segment is A, to recognize what's going on if you haven't kept up with gold and silver, but also B, to talk about why this is happening, because it is unusual looking at its historical returns. So there are a number of things. You spoke about A, it's seen as a reliable store of value. Yeah. And given what's going on at the moment, geopolitical unrest, interest rate uncertainty, inflation, gold, people turn to gold for safety.
Yeah.
And that's what's happening here. But also because we're now starting to see a change in the interest rate outlook. The US is starting to say that they're definitely going to be cutting rates. What happens there is that there's starting to be a weakening in the US dollar, which we've spoken about on the show. And then traditionally, this is where gold tends to perform well.
So can I just pause there? Because those two things, the first is in an inflationary environment where rates are rising, gold performs well because it's a hedge against inflation.
Yeah.
And now you're saying in a disinflationary environment where the interest rates are being cut and the US dollar is weakening, gold also performs well.
Yeah.
That's what you say?
I guess so.
Okay.
Yeah. Sorry. Well, I think the first is traditionally, if that makes sense, but what we're seeing now is the drivers now is that the weakening of the US dollar is what's sending people to buying gold.
Yeah,
there is another.
I think the actual through line between both of those is in a high inflationary environment or an environment where the US dollar is weakening, the commonality there is the US dollar is weakening.
Yeah.
And so gold is priced in US dollars, and so gold does better in environments where the dollar is weakening.
Yeah.
Whether it's for whatever reason is driving it.
Yeah.
Yeah.
The other factor is central banks. So back in 2022, the central bank gold buying binge kicked off.
Okay. So not just the US central bank.
Globally, and really led by China.
Yeah.
They started buying huge amounts of gold for their reserves. That started in 2022. The most recent quarter that we have had was the fourth largest quarter since 2022 of reserve banks buying gold. But yeah, it was the fourth largest quarter. So over the last 2 years, the reserve banks have been going nuts. And of course, this is putting pressure on the gold price.
If people want to go deeper on the whole central banks moving away from the US dollar, the episode to listen to in our back catalogue is the one with Chris Judd, because that certainly forms part of his investment thesis and sort of where he sees potentially the world going. I would say that the idea that the world is going to move away from the US dollar and the current iteration of it is the BRICS countries starting to do their own trade in non-US dollar currencies. And the BRICS is Brazil, Russia, India, China, South Africa is the S, I'm pretty sure. There's always variations of this. The classic example that I always go back to is Warren Buffett's dad only invested in gold because he was convinced that the US dollar was being inflated away and was worthless. And so all he did was invest in gold. And I'm sure he got all right returns from gold, but he could have done better if he was in equities.
Yes.
I think it's important to have a historical perspective on the idea that the US dollar's a few years away from dying, because it's been a few years away from dying for a century.
Yes, yeah, exactly. It's always ongoing.
But that isn't to say that gold doesn't have a role in the portfolio, and some of these geopolitical trends are real.
Yeah, absolutely.
It's just the speed at which they will play out.
Yeah.
Let's get back onto that. You can listen to the Chris Judd episode.
Yes.
As retail investors, it's important to know it's not just central banks buying gold. It's regular punters buying a lot of gold as well.
Absolutely. And I read that Costco sell gold bullion.
Yeah.
They are generating an estimated $100 to $200 million per month in gold bar sales. because of the frenzy in the gold price. And they typically sell these gold bars for about 2% above the spot price.
What the hell? I don't think it's just the frenzy in the price, because if you've ever been to America and listened to their conservative radio, the amount of people selling gold is wild.
Really?
Yeah.
Are they all those the guys who dig bunkers in the ground for the doomsday preppers? Yeah.
There's a lot of it's on, like Rush Limbaugh and like a lot of those right wing shows. It's like, doomsday preppers, weapons, and buy gold. Yeah. Fox News over there would have a fair bit of gold ads as well. It's a real thing.
Crazy.
But yeah, Costco killing it.
Wow. Well, anyway, we should probably close out with, if you're interested, how can you invest in gold here in Australia? And the recommended way, at least, is finding ETFs that are backed by gold and actually follow the spot price. They're not underlying derivatives.
Yeah. So to spell that out, gold ETFs will come in sort of two forms if you look under the hood. The first is a gold bullion ETF, where if you buy the ETF, they go and buy physical gold and they put it in a safe, and the ETF units correspond to real physical gold that is held, I guess, on your behalf as the ETF unit owner. The other one is a synthetic ETF that tries to track the price of gold using derivatives and other options. And what we're saying, and what experts around the world will tell you, is that buy the bullion ETF over the synthetic ETF. It will more closely track the price. There's less counterparty risk when rather than dealing with options and stuff like that. And there's no reason at this point not to buy the bullion one. Like the fees are similar, and it's just a better constructed product.
Yes.
So that's obviously generally speaking, but it's pretty emphatic general advice when you're looking at gold ETFs. The third kind of ETF you'll see are gold miner ETFs. Just be careful, you're not technically tracking the price of gold. It's like a leveraged bet on the price of gold with company risk built in.
Yeah. So 3 examples here in Australia. You've got the Global X Gold, which is the biggest gold ETF. The ticker is gold. Then there's the BetaShares Gold Bullion, ticker is QAU, and the VanEck Gold Bullion ETF, the ticker is NUG, NUGG. Now, not advice, because there is no guarantee that this is going to continue. But if you are interested in having gold exposure, there are some examples for you.
Nice.
A reminder that if you've enjoyed that headline and you don't want to miss out on any others, to make sure you sign up to our daily newsletter. Link will be in the show notes, where we send you the latest in business and news headlines, as well as answers to your questions from experts. So make sure you're signed up.
A cheat sheet is a quick reference guide or concise summary of important information.
All right, well, it is that time for our latest segment. We're calling it Cheat Sheet, and we are going to be looking at some of the best investors, politicians, and celebrities' portfolios to see what we can learn and perhaps what we can borrow.
Before we get into it, Ren, why are we calling it Cheat Sheet?
Because it's a good opportunity to cheat off some of the smarter kids in the class.
Nice. Yeah. Well, that's essentially it, isn't it? Like in investing, there's no cheating.
In investing, there's no points for originality.
Yeah. Like so we're going to hopefully be able to take some ideas from the big guys.
Yeah. And look, to start off this segment, we were wondering whose portfolio we should look at first, but there is no investor that captures the attention of people on social media, retail investors, more than one investor who has made incredible returns over a multi-decade period. You can't invest with her, but you can certainly track her trades. It's Nancy Pelosi.
Nancy Pelosi, that's right. She is an American politician. She's been in US politics for so long. And has really leveraged her connections and insider knowledge.
No. She has allegedly.
Allegedly.
Look, I think there's a pretty clear problem with US politicians having access to privileged information, not necessarily inside information, but privileged information, and then making money on the back of that. And Nancy Pelosi is kind of seen as the poster child of this. But look, we're not going to get into that conversation. There's currently a bill being considered by the US Congress to ban politicians trading stocks. So we'll let them have that conversation. But here is Nancy Pelosi's portfolio. Let's start with the companies and then talk about what we can learn from it.
So she's got Nvidia, Alphabet, Tesla, CrowdStrike, Apple, Disney, Alliance, Bernstein Holdings, Visa, Broadcom, Amazon, Microsoft, and Palo Alto Networks. So 12 companies there.
Initial takeaways?
Well, it looks very much like the NASDAQ 100/S&P 500 top 10 holdings.
Yeah. Well, I think my initial takeaway is it's obviously very tech heavy. And perhaps that's not surprising given that she is a representative from California.
Yes.
So, they're probably the companies that she knows best. But yeah, very tech heavy. Nvidia, Alphabet, Tesla, Amazon, Microsoft, Apple. So is that all of the Magnificent Seven that I just read out? 4,
Yep.
5. So which one is she not bullish on?
So it looks like Meta she is not a fan of, which is interesting because I now see it at the top of a lot of other professional investor portfolios.
Yeah. I guess there's probably a world where she's trying to regulate Meta. Probably not a great look to be.
I mean...
Yeah, true. That's I
don't think she's that concerned. Look, Nvidia is not surprising to see at the top as well. She's been buying that up lately, I know, has been in the media. There's a website called quiverquant.com
they're good.
that tracks all of her trades.
Yeah.
And what is interesting is she has gone hard since 2020 in buying. In 2020, she had trading volume of 34 million. In 2021, 20 million, and in 2022, 18 million. So heavy buying, but also has made 170 trades. So pretty active.
Yeah. Look, to be fair, I'm pretty sure a lot of it is her husband, Paul Pelosi. But
oh, really?
Yeah.
Is he a?
No. He's just.
Oh, it's just. That's what it is.
I think, that's she's not like she's trading. It's not like she's on Robinhood trading stocks during the day. Yeah, is what I'm saying. But look, a couple of other notable names I think we should talk about. So a bit of a tilt towards cybersecurity.
Yeah.
CrowdStrike Holdings, which obviously we all became very familiar with the Microsoft outage, and Palo Alto Networks, another big cybersecurity player. All right, well, that's the first cheat sheet. We've got a professional investor coming up next, but any final takeaways from Nancy Pelosi's portfolio?
No. I think it's pretty tech vanilla. There's nothing in there that's like, wow, that's interesting.
Yeah, for me, it's like you could just buy the NASDAQ 100 and focus on, I don't know, winning elections, but you can't argue with her results over the past 2 decades in terms of compounding capital.
No.
Speaking of compounding capital, let's move to our second portfolio that we're going to take a little peek under the hood of. We've got Bill Ackman's portfolio. Now, for people who are not familiar, Bill Ackman he's a billionaire hedge fund manager. He's been doing the thing for maybe a couple of decades as well. His firm is Pershing Square Capital Management. They're listed over in London. I don't really know what he's famous for. Back in the day, I think he was quite an activist, but he really just was he was seen as a bit of like a wonderkin back in the day. Had some incredible performance.
He also went really hard on some big short positions.
Is this during COVID?
No, wasn't it before COVID? It was on the like Herbalife.
Oh,
and,
true. Yeah.
Became
you're
real,
right.
like really came out hard on some of those. What he said
right.
were
And,
like performance marketing schemes, essentially.
Pyramid
schemes.
So how we've got Bill Ackman's portfolio is that all of the big hedge fund managers over in the US every quarter have to disclose what they've been buying and selling. It's in a 13F filing. So this is Ackman's 13F filing from the 30th of June 2024. That's the portfolio date. Here are his holdings. Hilton worldwide, 18% of the portfolio, biggest holding. Then Chipotle, Mexican Grill, Restaurant Brands International, Alphabet, Howard Hughes Holdings, Canadian Pacific Kansas City, Brookfield, and Nike. So, initial takeaways.
A lot more interesting than Nancy Pelosi.
Yeah.
I like that. A couple of things. So 8 companies in there. So high concentration.
Yep.
If you look at his top holdings, and this is somewhat in contradiction to some of the experts who come on to talk about portfolio construction, but his top 5 or top 3 holdings, let's call it, Hilton is almost 20% weighting, Chipotle is 17%, and Restaurant Brands is 15%. So hard on sort of consumer and whatnot.
Yeah, we should be clear with these portfolio weightings is they only have to disclose American holdings.
Yeah.
So he probably has some international companies, but you're right, it's a very, very consolidated portfolio.
Very consolidated, yeah. My other takeaway is there's 2, in terms of recent activity, 2 buys, one of which I think is very opportunistic in Nike.
Yep.
So that was a recent buy. This is as of 30th of June, 2024. We know very soon towards the end of June, Nike took a bit of a tumble on some earnings outlook. So maybe perhaps some opportunistic buying there. What about you?
So I think if you look at those big holdings, something that I'm reminded of again and again when it comes to investing is that the best investors, those that make the most money and have grown the most wealth, aren't buying unknown companies. When you look at their portfolios, it's not a list of companies that you've never interacted with before or you've never heard of. And if we just go down this list, Hilton, most well-known hotel chain in the world. Chipotle, so well-known as an American restaurant that we know about it here, even though it doesn't exist here in Australia.
Yeah.
Restaurant Brands International owns a number of well-known American companies, best known Burger King.
Yes.
Yeah. So again, very well known. Alphabet owns Google, very well known. It's like the top holdings are very well known companies.
Yeah.
And we've had a look at Bill Ackman's 13Fs before over the journey of Equity Mates. And the second big takeaway is that these top holdings just don't seem to change. Like year after year after year, it's Hilton, it's Restaurant Brands, and it just, just always is.
Yeah.
Yeah.
Well, he's got billions in them, so it would have been awesome to. Yeah. Unfortunately, they don't put here what their returns are, but yeah, that would be epic to see. Because you're right. I remember seeing Hilton, Chipotle, Restaurant Brands. He's had them for a decade.
Yeah. Now, a couple of lesser known companies: Howard Hughes Holdings and Canadian Pacific Kansas City. So, what can we learn about those 2 companies?
Okay, well, I'll Howard Hughes, Ren. It's not the holding company for the aerospace guy.
Okay, yeah. Yep. What was the Howard Hughes movie?
You're quizzing me. That wasn't the question.
The Aviator.
Yeah.
So
Good
it's
movie.
not about him.
Yes. No, Howard Hughes Holdings is actually a real estate development and management company based in Texas. Again, it looks like a bit of opportunistic buying. Not sure when he bought it, but it has taken a bit of a tumble. It hit a bit of a low midway through April. Is only up 1.7% year to date. Not sure how long he's been holding, but there's some insight for you.
Okay, thanks. And then the other company was Canadian Pacific Kansas City. It's a railway company. We see interest in railways from a number of big investors. Buffett obviously has big railway holdings. And I guess it's because they're quite defensive assets. Like if there's one railway built, it's unlikely someone's going to invest the capital to build a competing railway these days. So they can kind of own routes. Canadian Pacific Kansas City was formed at a merger a couple of years ago. It's the only railway that connects the 3 countries of North America. It runs from Canada into America down to Mexico. And so he obviously is bullish on this railway thematic. Volumes are going to increase. They have pricing power and they've got they're defensible. Similar thesis to Buffett, I imagine.
So there we go. That is Cheat Sheet segment number 1. We did Nancy Pelosi and Bill Ackman from Pershing Square. We'll continue finding portfolios from some of the best investors from around the world to see what insights we can take as we head towards the end of the year.
Yeah, and if you have an investor that you want us to have a look under the hood and see what they own, let us know and we'll see if we can find their portfolio.
We're going to take a quick break, and on the other side, we've got another Pimp My Portfolio with Adam Dawes and a community member. We will be right back. It is time for
Pimp My Portfolio. Pimp My Portfolio. portfolio.
Alrighty, well, we're really excited for this one. We have a community member who has submitted their portfolio for our expert to give some ideas on how to make it a little bit better. Today, from the community, we have Brent joining us. Brent, welcome.
Thanks very much for having me, guys.
And our expert is none other than Adam Dawes. Adam, welcome.
Thank you. It's great to be here.
Now, Brent, we'll kick off with Ren giving a bit of a down low on what your portfolio is.
Yeah, so Brent's portfolio, it's got 18 holdings. It's got one ETF, the Vanguard Australian Shares Index ETF, which is about 15% of the portfolio, and then a number of individual stocks. Some of the bigger holdings are MinRes, 20% of the portfolio. We've got GQG Partners, the fund manager, at about 16% of the portfolio. So there's some of the bigger names. And then we've got Step One at 6 or 7%, Lavisa also at 7%, and Laserbond at 6%. So they're some of the bigger names in the portfolio. But Dawsy, we always like to start with a bit of a nickname.
Yeah.
So what have you got for us?
So, Brent, I think, and talking about Lavisa, so I do love this portfolio, and Laserbond, you do have laser focus on this portfolio. So, and
I love it.
and it does have some elements from Elementos. It does have some elements of good in the portfolio, but we don't want it to stay out in the desert too long. We've got to bring it back in. So there you go. That's my nickname.
Nice. So Desert Metals is also a holding in the portfolio.
There we go.
For people playing along at home. Brent,
Sorry, DM1's gone too. Sorry, I scrapped that.
DM1's out.
Okay.
Not out in the desert anymore.
Sorry.
All right, we'll have to change that nickname next time. But do you want to tell us a bit, Brent, about how this portfolio came to be?
Yeah, 100%. So in 2016, I bought my first stock on IPO. It was IPH. Did pretty well out of that. And then I sort of put that back into Megaport, which then went up I got a 4-bagger on that. And sort of I got really into it. I really enjoyed it. And sort of anything I touched sort of did relatively well for a period of time. And then 2021 hit and everything went to shit after that. So I've made every single investing mistake in the book. I should have sold and didn't, and for tax free, all sorts of things. But look, fundamentally, that's kind of what changed my whole perspective on this. I realised I want shares to be a considerable investment for me in the future, because I really am sort of sick of work and I don't really want to do that anymore. I'd rather just earn lots of money for my shares. Yeah, so it was probably around end of 21, early 22 when I started to really understand my investments and understand what I was trying to achieve. And so you'd almost draw a line to the portfolio with a couple of things that look like turkeys and some others where I've got a lot more conviction and understand the business a lot more. So Laserbond's one of them, for example, where I like the story. I find it relatively easy to understand. Yeah, a couple other ones like Neometal's example, which was just basically I just bought it because someone told me to, and now I'm in trouble. You know what I mean? So yeah, I've thought a lot. And I spent a lot of time on my portfolio, like too much time, and just keeping up to date with the market and understanding everything that's going on. I really enjoy it. There's a few things. It's been sort of bolted on. There's a lot of things that have been bolted on. But, yeah, the more successful ones are the ones where I feel like I've got a good understanding of them. And I think that's probably the best way to sum it up, how it all started.
Nice. Well, Dawsy, what are your thoughts? And I guess the point of this is to help Brent think through how he can improve the portfolio.
First of all, I think, you've got 18 stocks in the portfolio, or maybe 17 now, and plus some more international in there. So I think you've got a good diversification in the portfolio as far as the number of stocks. I think you definitely need to look at some of the weightings. Obviously, Min Resources is probably one of a larger holding there at sort of 20%. So generally, it's around about a 5 to 10% weighting that we like to have in clients' portfolios. If it's a really good quality blue chip like Macquarie or BHP, I'm happy to go up to 20%. MinRes is actually a very good stock as far as that it's got the new world, which is lithium, and then the old world, which is iron ore, and then sort of mashing that together. So I think you're okay there for that. So, but yeah, I'd look at weightings. The second thing I'd definitely look at is asset allocation. Asset allocation is basically looking at the entire portfolio but having a certain weighting into Aussie stocks, a certain weighting into international stocks, certain weighting into property, defensive income, those kinds of things. Now, you've got some international shares in there where you've got GQG and you've got some managed funds in there. But generally, for a balanced investor, you'd like to have about 30% weighting in international stocks. Okay, so building up that international component to around about 30% is probably going to give you the correct asset allocation going forward. So I think that's really important to think about starting with.
So are you saying GQG is giving me that access, or is that
so
part of it?
Is part of that international exposure. Yes, that's correct.
It's a funny one because they're listed in Australia, but I think they're based in Florida over in the States, and they're investing globally.
Global. And it's done well. They've got lots of inflows coming in compared to some of the other fund managers that have outflows.
Yeah.
So one question I have, Adam, at least about half of the portfolio have position weighting less than 5%.
Yeah.
There's some that are 0.5, some that are just below 5%. When you say you're looking at positions of 5% or more, if a stock if you invest in initially the position is 5 or 6%, it drops to 1.5%. It's then back up to 2%. Are you saying you need to top it up to 5%? How do you play that balance between it initially being 5% and then underperformance?
Yeah. So first of all, you obviously, if you buy a stock and it starts to go lower, if you've got confidence in the management and you've got confidence in the market and the segment that it's in, then yes, you would continue to top up. You don't want to continue to keep topping up losing positions because then you're just basically throwing bad or worse money and bad, going forward. So I would definitely look at the position. What I usually do for clients is a third. So in other words, or 33. Yeah, so a third. So we would take an initial position in the stock. And then what I would put another third a little bit lower. So if it does continue to go lower, we're going to average our costs down. If it starts to go higher from there, at least you've got some position in there, and then you can start to top it up as it goes higher. But looking at that third with a 5% weighting minimum in any one stock. Some of these stocks that you've got in there are really good stocks, but if you've got 0.5% or 1% in the portfolio, it's actually not doing anything It needs to have that concentration. And I think that's where people go, oh, well, I'll just put, a little bit in here, a little bit there. But it really doesn't meet the portfolio of a structured portfolio that's well thought out.
Yeah. And some of those really small ones are sort of just starting positions. Like what I did with the Visa, when I first picked that up, I picked up 25 shares. And in the last 6 or 12 months, I picked up 25 sort of every month or so when I had a little bit of cash.
Yeah, great.
So that's why they're a little bit all over the place in terms of their weightings. And there's a couple like Baylor's one that I was holding off to see how they were going to use their cash. And in the last 2 weeks, I think they've made $40 million worth of investments into a couple of small businesses. So I'm now sort of a bit more sure of where they're going. So that might be something, for example, that I'll top up in the next week or two potentially. And if I run out of ideas, then I just put it into the Vanguard, the VAS. So I sort of have a continual way of investing each time, and I sort of look at what's my best option at any one time in that respect.
Yeah, so a regular contribution strategy is a great idea.
Is that a...
Absolutely.
Yeah, okay.
Absolutely. It's a great idea.
Yeah.
The idea of the regular contribution strategy is that potentially you'd put it across the entire portfolio. I know that's a little bit difficult with this one, but you would just continue every month to put more money in. If the market's up, you're putting more money. If the market's down, you're putting more money in, or the stocks are up and down. So regular contribution strategy, absolutely. And then if you are not a lot of these, or Soul Patts pays dividends, but turning on the dividend reinvestment, okay? So that combining that compounding of that over the time will grow the portfolio, and that's how you build the portfolio over a longer period.
Yeah, 100%. That makes perfect sense. And that's what I intend to do with the VAS as well. Just leave it there until I turn 60 or whatever, and hopefully it's worth a lot more than it is now, So how do you have a like you said, every month or so you put into the market and it goes across your portfolio? I don't quite know how do you do that with that amount of stocks?
You can't. It would be more, you'd have to pick the ones. There are model portfolios that you can add regular contributions, and it will go across the entire portfolio. For this one, you just need to continue to run those ones, and always topping up the ones that are potentially winning. It's like gardening. You got to get rid of the weeds to let the flowers grow.
Yeah.
Nice.
Yeah, you couldn't. 17. The brokerage cost alone on doing it across all 17 would be crazy.
Yeah.
But like, if there's a more concentrated list that make more sense, then yeah.
Oh, I see. Yeah, I see what you're saying. Yeah. Well, I use CMC, and I think they don't charge any brokerage under $1,000. So that's why I don't mind picking up $250 or $500 at a time and just chipping away at sort of like that. If that makes so, even if I have $500 sitting there, I could buy 2 small positions at $250 each.
Yeah.
So
You could. A lot of admin, but if you want to do it.
Yeah.
The problem is as well, I guess, with Australian stocks, because they're not fractional. You know, if the share price is like $150, then all of a sudden you might not be able to do your regular contributions.
Yeah.
But yeah.
Yeah, I'll tell you what, if laser bond goes from 70 cents to $150, that won't be too big of an issue for me, I don't think so.
Then you'll get your retirement dreams.
Yeah, I know, right? No, it sounds great. So basically just a bit more overseas with US exposure. And what was sort of the other little point you'd like me to think about?
Yeah,
get rid of the weeds.
Yeah.
Yep.
Some of the stuff that's not working for you, just get rid of it, cut it, move on.
I think the main thing to think about here is the percentage of your portfolio and your weightings.
Yep.
What's the point in having something that's 0.5%? Is that really contributing to anything in the portfolio? And is there an opportunity for that money to go somewhere else that's going to be a bit more meaningful?
Yep, understood, fellas. Thank you very much. That's amazing.
No worries. Well, thank you for submitting, and we really appreciate it. And good luck with it.
Thanks so much, and thanks for the amazing resource, guys. This is just an awesome podcast. I can't stop listening to it. So,
we
thanks
appreciate
again.
that.
You're doing amazing work.
Yeah, we appreciate that. Thank you.
If you'd like to submit to Pimp My Portfolio, just like Brent, you can head to equitymates.com/contact, and all the information is there. We'd love to hear from you. And if you would like to be put in touch with Adam for investment advice professionally, then head to equitymates.com/advice and we'll connect you. But Adam, as always, thank you so much.
Thank you.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.